So every founder eventually faces this critical choice, right? How do you fuel your growth? Do you end up trading a piece of your dream for cash? Well, what if you didn't have to? Today, we're going to break down a really powerful strategy for getting the capital you need while you get to keep 100% of your company. This is all about funding without the forfeiture.
Look, you've got the vision, you've got the plan, but you're missing that fuel to really ignite it. And yeah, the traditional path, it points straight to venture capital, to selling off pieces of your dream before it's even fully baked. But is that really the only way? Let's challenge that assumption for a minute.
All right, here's our game plan. We'll start with that classic founder's dilemma. Then we'll reveal an awesome equity-free alternative. We're going to show you exactly how it works, unpack its interest-free advantage, and of course, cover the risks you need to know about. Let's dive in.
Okay, first things first. Let's talk about the true cost of money. You know, that first check from an investor, it might feel like this huge victory, but honestly, it's often the most expensive capital you will ever take. And the price? It's your ownership and it's your control. I mean, think about this for a second. For just $50,000, a lot of founders hand over up to a fifth of their entire company. That's a massive sacrifice of future wealth and control, right out of the gate, for what's basically just money to get to the starting line.
But what if you could just bypass that trade-off completely? What if you could use the financial system to your advantage and bootstrap your way to growth totally on your own terms? Well, this is where a really powerful equity-free alternative comes into play. This strategy is called credit card stacking. So here's the big idea. You apply for a stack of high-limit business credit cards all at once. The goal isn't to go on a spending spree. It's to strategically unlock those incredible 0% introductory APR offers, which creates this powerful line of interest-free capital.
And the potential here is significant. We are not talking about pocket change. If you do this right, this strategy can unlock up to $150,000 in capital, all without having to write a single investor deck.
Let's put these two paths side by side, okay? With an investor, you're trading equity in control. But with 0% stacking, your equity cost is zero. You keep 100% control. Investors often want to see revenue. This method doesn't require it. And crucially, it's unsecured, which means your personal assets, they stay completely off the table.
So the big question is, how does this actually work? Well, the mechanics are pretty precise, and they are the absolute key to making this whole strategy successful. So let's break it down. It's really a three-step process. First, you apply for several business cards from different banks all at the same time. Second, and this part is critical, you strategically spread those applications across the different credit bureaus. See, this prevents the banks from seeing your other recent applications, which maximizes your chance of approval. The end result is a large line of credit at 0% interest for up to 18 months. And this right here is the real game changer for early-stage startups. This whole strategy hinges on your personal credit strength. We're talking a FICO score of 680 or higher typically. It completely bypasses the need for business revenue, which makes it the perfect tool for pre-revenue companies that are ready to make their first big move.
And that brings us to the most powerful part of this whole thing, the interest-free advantage. Let's look at a real-world scenario to see just how ridiculously impactful this can be for a bootstrapping founder.
Just imagine you need 50 grand for inventory. With a typical business loan, you'd be looking at high monthly payments driven by that interest. But with 0% stacking, your interest rate is, well, zero. This means your monthly obligation plummets to just a tiny minimum payment, freeing up critical cash flow. So if you pay it back within that intro period, the total cost of that $50,000 is exactly $50,000, not a single penny more.
I mean, just think about that. You are effectively using the bank's money for free to launch and grow your business. It is pretty much the ultimate bootstrap hack.
Now, of course, a tool this powerful has to be handled with care. This is not magic money. It's a strategic form of leverage, and that means you absolutely have to understand and respect the risks involved. You have to be disciplined.
So here are the key things you need to manage. First, since these are business cards, they generally don't report to your personal credit, which protects your score, as long as you pay on time. Second, that 0% window is temporary. You have to have a plan to pay off the balance before those standard high interest rates kick in. And finally, discipline is everything. One late payment can instantly just void the 0% offer. So it all boils down to this. All funding involves risk. That's just part of the game. You can risk your equity, or you can risk taking on debt. But when that debt is interest-free, and it allows you to keep every single share of the company you're pouring your life into, well, doesn't that kind of change the definition of a smart risk? For the right founder,
This might just be the single best bet you can make, a bet on yourself.